What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome to another episode of the CPA Zone. I'm your host, Ryan Pulis, and today we're diving into a case that deals with renting to family members. So this court case is called Okonkwo v. Commissioner, Tax Court Memo 2015-181. Hopefully I'm not butchering that last name too bad. So let's unpack what went wrong here and talk about how you can avoid running into the same issue. So we have the taxpayers, Charles and Cecilia Okonkwo, who were doing pretty well. Charles was a cardiologist. Cecilia helped with his practice, worked for him. They lived in Bel Air in Los Angeles, and they owned a rental property in Woodland Hills, California. Now, initially, the first several years, they rented this house out to an unrelated party for $6,000 a month. So far, so good. Definitely a rental property, no issues. But then their daughter moved in. They were only charging her $2,000 a month rent, which is well below the fair market rent. They were just getting $6,000 from an unrelated party. And that's where things started to go wrong. So the Okonkwos deducted over $100,000 in expenses against that $24,000 of rental income each year. So then mortgage interest, taxes, insurance, depreciation, your common rental expenses. So the first year their daughter rented the house, they treated the expenses as passive. So they reported the activity on Schedule E, treated the loss as passive, and suspended on Form 8582. But then the following 2 years, they tried claiming they were in the construction business, reported the activity on Schedule C, and treated the losses as deductible. So they're offsetting their other income. Then they went back and amended that first year where they reported the activity on Schedule E and moved it to Schedule C, again, deducting the losses. And the IRS issued a notice of deficiency for all 3 years, claiming they weren't allowed to deduct the losses and therefore had balances due, plus penalties and accuracy-related penalties. Now, let's talk about the section of the law here that's really kind of dictating what's happening. So Section 280A of the Internal Revenue Code involves personal use of a residence and includes some of the rules that real estate investors that rent to family members really need to know about. So if you or a family member use the rental property personally, then your deductions can be limited. Because if you use it for 14 days, the greater of 14 days or 10% of the days it's rented at fair market value, then it's deemed a residence and not actually a rental. So when you rent to a family member below fair market rent, that is considered a day of personal use. So in this case, their daughter was paying below fair market value rent. The days she was in the property were all considered personal. So even though she was technically paying rent, it wasn't at market rate. That's considered personal use. The IRS did not buy they were in the construction business either, and that this activity should be reported on Schedule C. So that did not fly. That did not help them at all. And the tax court did not buy it either. In fact, I suspect going back and amending that I think the tax years in question here were 2008, 9, and 10, when they amended and then filed the activity with the massive losses on Schedule C. That's likely what started raised the red flags for the IRS. So a dwelling unit is considered a residence if it's used personally for more than 14 days or 10% of the days it's rented at fair market value, as we previously mentioned. So this is all under Section 280 Cap A D. So personal use under there includes used by the taxpayer, used by the taxpayer's family members, unless it's rented at fair market rent. And then time spent doing repairs are days, that's an exception for personal use. If you're at the property doing repairs and you spend the majority of the day, So usually at least 4, maybe better to get closer to 6 hours. If you're there working, doing repairs and maintenance, that is an exclusion from the personal use rules. But if you're using it personally, or a family member is using it personally, or paying less than fair market value rent, personal use. So in this case, because their daughter lived there, paid less than fair market rent, all of those deductions they took were disallowed. They could take the $24,000 of rental income down to zero and not pay tax on that, but nothing else. They're not suspended losses. They're not deducted on Schedule C like they tried to do, claiming they were a construction business. All they were entitled to was to offset that $24,000 in rent that their daughter paid them. So, as you can guess, the IRS disallowed those deductions, except to the extent they wiped out the income. They were hit with penalties, accuracy-related penalties under Section 6662 for negligence. They were able to get out of some penalties because they relied on their CPA that didn't explain to them the rules for renting to a family member. So some of those penalties were disallowed, but they were still hit with a portion of accuracy-related penalties, and they owed all the back tax plus the typical IRS interest and penalties assessed on that. So no one wants to run into that. So the takeaway from this is make sure you're charging fair market rent when you rent to a family member. Now, it doesn't necessarily have to be exactly equal what you get to a third party, maybe a bit of a discount because you know them and trust them, but we're talking minimal. It's got to be really close to that fair market value rent. So make sure you're not cheating yourself out of deductions, or just at least know if you're going to let a family member live there for less than fair market value rent, report it correctly. Make sure you have good documentation. You can offset the income, the rental income they pay you, but you're not going to take any losses. Make sure everything's documented, have a lease, good documentation always helps. And make sure you're tracking your personal use days, especially if you're getting close to that. I see people that use the short-term rental strategy. I've seen cases where they blow it up because they also use the property personally, and then the short-term rental loophole does not work because they had too much personal use of the property. My advice, if you are using the short-term rental loophole, have 0 personal use days and treat it as strictly a rental property. And make sure you are discussing things with your CPA or advisor before you run and start making changes to your tenants, or if you're going to rent to a family member, make sure you let them know so you're both on the same page and there's no confusion at tax time and everything's reported correctly. So that about does it for today's episode. If you found value in this, please hit that like and subscribe button and leave us a 5-star review. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.